My name's Will. I am your host, and I've spent nearly a decade building companies that today help millions of renters better manage their homes. We started Gravy 2 years ago with a very specific goal to help renters save smarter and buy their first home with confidence. And one of the ways that we do that is by partnering with the best real estate agents and the best mortgage lenders in the country, like Sukesh, who is joining me today. Hey, Sukesh.
Hey, well, hi everyone. I'm Sukesh. I run a mortgage company and I'm a mortgage coach. I'm passionate about the American dream of homeownership. Before this, I was a PhD chemist and worked in the oil and gas industry. And like you, a few years ago, I was really frustrated about the process of buying a home, and so much so that I quit what I was doing to help more folks realize the American dream.
Awesome. Thanks. I'm still working on my PhD. So you've got me beat there. But to get into the agenda, intros, check. We've done it. I'll spend a few minutes talking about really why it feels so daunting when you set out to buy your first home and how Gravy's tackling that challenge to make it easier than ever for first-time home buyers to succeed. Sukesh will cover everything you need to know about mortgages, how to get approved, how to get a great deal, and then we'll leave some time at the end for Q&A. So please add your questions into the Q&A box and we'll answer them in a bit. So Gravy's mission is to make homeownership more accessible for all. Why? Well, before we talk about all of the hard parts that come with buying a house, let's take a second to highlight one of the reasons why buying your home is worthwhile in the first place. The median net worth of a renter is around $6,000 in the US today. It's over $250,000 for a homeowner. That's a 40x difference. Homeownership is the #1 way that Americans build wealth, and it can and will be for you too. We think it's too hard to buy a house, and in particular, we think it's even harder to buy your first house, and we've set out to solve exactly that. And from our countless conversations with renters and aspiring homeowners, it's clear that you agree. On to the hard part. So we asked 200 aspiring home buyers, what do you need the most help with when it comes to preparing to buy your first house? What's the #1 thing? Well, 7% said, I don't even know where to start. 15% say the down payment is the biggest barrier to homeownership for them. 17% building their credit in order to get approved for a mortgage. And a whopping 57% say the one thing that is most difficult about buying your first house is actually all of the above. I don't know where to start. I need to save my down payment. I need to work on my credit. Help me. And then there's 4% who say it's something else. And for us, what does that really mean? Not only is preparing for homeownership hard, but it's really this multifaceted challenge. But perhaps most interesting in my mind is that almost all of the hard work happens before you ever go to an open house with a realtor or apply for a mortgage with a lender. Unfortunately, the traditional home buying industry is really catered towards folks that are ready to buy today. They've got the down payment, their credit score is in good shape. They want to buy something in the next 3 weeks or 3 months. The traditional home buying industry is set up to help those folks really well. But that's not what renters tend to look like. There is a whole bunch of hard work that is required upstream of that more fun conversation about touring open houses and getting the keys to your new home. First and foremost, just getting started. So you all are here. That's amazing. Check that off the list. You are on your way. The second, I mentioned it, saving the down payment. Third, building your credit. Next, learning the ABCs of home buying. You've never bought a house before. What the heck is a mortgage anyway? How much can I even afford? And finally, are you ready? Where are you from a personal perspective? Do you have a stable job? Do you want to buy a house perhaps after you get married or after you have kids? These are all really important questions that you need to answer before you start in earnest looking for a new home. And while Gravy can't help with the marriage piece or the kids component, we can help with everything else. We call it a super app for first-time home buyers, and it's got everything you need to buy your first home with confidence in one spot. At the top of the list, rent rewards. Earn 5% back on your rent, redeem it towards your future home purchase. Take your biggest bill every month as a renter and turn it into something that will actually help you achieve your goal of home ownership and save you a bunch of money. The ultimate down payment savings account will help you save faster and save smarter. You can track and build your mortgage credit score, the one lenders actually care about. You'll get human help all along the way. And finally, when you are ready to buy, your down payment is saved, your credit is in good shape, you understand the ABCs of home buying. We have a national network of agents and lenders who are the best of the best at what they do. And what they do is help first-time home buyers just like you find and finance their first home. And in addition, they'll also redeem your Gravy rewards to save you a bunch of money on that purchase. So without further ado, let me introduce you to one of those amazing partners that I just mentioned. Sukesh, I'm going to turn it over to you to talk a little bit about mortgages.
Super. It's my favorite topic in the world. So we'll cover 5 things today. What is a mortgage? How do you qualify for a mortgage? What are the different types of mortgage? Rates, which is what everybody cares about. And what is new in 2023? Let's dive in. The word mortgage or mort is the root. It comes from the French, which means dead, and gage means pledge. So the literal translation is a dead pledge or an agreement until death. That's pretty morbid, but the agreement is not, for us to die. The agreement is for the loan to die. So essentially, you're pledging your house until you repay the loan. That's what the word literally means. And everybody needs a mortgage. Unless you're the lucky 5% who can pay cash, everybody needs a mortgage. So everybody has one. It's really important to understand how they work. One interesting thing is a mortgage is not one thing, it's actually 2 things in most states. The first is a promissory note. So when you sign, a ton of paperwork in your last day of closing, you'll sign 2 major documents. You'll sign a lot of documents, you're signing your life away. But the 2 things to understand about a mortgage is the first is a promissory note, which is just a promise to repay the loan to the lender, terms that you signed up for, which is what is your loan balance, what is your interest rate, what is your term payment. It's just basically all the nuts and bolts of what is in your loan. The deed of trust is actually something you shouldn't trust. It is actually an agreement between 3 people, yourself, the lender, and a trustee, and it determines what happens if you don't pay your mortgage, right? So you're making an agreement to repay it. If you don't pay it, you're basically agreeing that a trustee, can take over your home, foreclose it, repay the loan, and it allows the home to proceed from your possession into the possession of the trustee for foreclosure. Of course, we don't want that to happen to anyone, but I would just understand what is even in a mortgage, sort of technically and legally speaking. So just something to remember for when you're about to buy a home. The second piece I would say is mortgages are magical. And the reason they're magical is, one, they let you get to the American dream of home ownership, but you're effectively borrowing money in inflationary dollars. Like inflation is a problem, but if you borrowed, $500,000 today, tomorrow that money's worth less. So you're borrowing today to buy a home today and paying those dollars off tomorrow. That's a great deal. The second thing that's a great deal is you're not spending this money. You're buying a home, which is appreciating over time. So in financial terms, that's an amazing trade because you're borrowing a depreciating cash source and buying an appreciating asset. It's an amazing deal. The problem with it is if you don't pay attention to it, you'll end up paying a lot in interest. And that's what's really important to understand. What can you do upfront when you get a mortgage to lower your rate and lower your interest expense over time? And then also, what can you do over time to pay off your mortgage faster? Dive in. So the monthly payment is not just your principal and interest. Taxes are a huge part of it. Usually like 20 to 22% of your monthly payment is taxes and insurance, and then HOA if you have any. So, but when you calculate the affordability of how much home you can afford, people are looking at all 5 of these components. The magical question, how do you qualify? When I thought about qualifying, I was like, how does a loan actually get approved? And if you understand what are the 4 things that mortgage underwriters who actually approve you, this is not your pre-approval, this is your actual approval, what do they look at? Once you understand those 4 things, it's quite easy to qualify for a loan. So let's look at the 4 C's of mortgage underwriting. This is like a mnemonic that they teach actual mortgage underwriters. And I feel it's easy enough to remember as normal consumers, we can also remember it. The 4 C's are capacity to repay your loan, credit, basically your credit worthiness to borrow money, collateral, which is what are you borrowing that money against, which is essentially the appraised value for your home, and cash being, do you have the down payment and the closing costs, which range from 2 to 5% to actually close on the home. So those are the 4 C's. And I feel like this is the most important thing I wish I had known when I was buying a home, to understand what these 4 things are and how they're calculated. And that really will help you get a great deal in your mortgage in the next steps. Let's go one by one. So capacity is how much money do you make and how much of that money can you allocate to repaying your mortgage. In simple terms, there's an equation that they use, which is called the debt to income ratio, but it really means how much can I pay towards my loan. The way it's calculated is very simple. Let's say you make $100,000, $120,000 in income. You divide that by 12 to get to $10,000 per month. That is your starting monthly income. Next, you multiply it by 45%, so you get 4,500, right? That's the maximum you're allowed to pay across all your debts. Let's say you have $700 of a car payment and the minimum credit card bills, right? That brings you down to $3,800. So it says, okay, now I have $3,800 that I can allocate towards principal, interest, taxes, and insurance. A couple of slides back, I'd mentioned that 20%, 22% goes to taxes and insurance. So you sort of multiplied by the difference, which would be 78%, and you get to your remaining, how much can you actually borrow? That number would roughly translate to $3,000. We started at 10,000, we came down to 3,000 after going through these steps. And then what you do is you plug that $3,000 in as your monthly principal and interest payment into a mortgage calculator. And the 2 other variables you need is, what is your interest rate? Let's say interest rate is 6%, and the term, which is the length of your mortgage, is 30 years. It'll spit out what is the maximum amount you can borrow. And in this case, the maximum amount would be right about $500,000. And that number is very sensitive to essentially your rate. That's the number it's most sensitive to. And then if you think about how much home am I actually going to buy, if you can borrow 500,000 and you're putting 5% down, the max home you can buy is 525. I hope that makes sense. Let's go to the next piece, which is credit. I would say credit is the number 1 determinant of your mortgage interest rate. There are many things that matter, but one thing that you can control is your credit score. Over here, this chart shows that 50% of borrowers have credit scores above 740. And essentially, it's the number 1 thing you can do. Your mortgage monthly payment actually will go down as much as 15% if you have the best credit score. So boosting your credit is the most important thing you can do before you apply for a loan. Let's go to the steps of how you boost the credit. The first thing is you track the right score. The Gravy app lets you do it. It's not the score, the Vantage 3.0 score that you see on your bank statement. Gravy will tell you exactly how to track it. The second one is you want to maintain as low as an interest balance as low balance as possible on your credit cards. You call this maintaining zero credit utilization. The next piece is please do not apply for new credit in between when you apply for a mortgage and when you close your home, or even very recently. Don't get a new car, don't open a new credit card. It's very important. Don't close old credit cards. A lot of times lenders will look at how many, do you have 2 to 3 old credit cards in good standing. I recently had a couple who, they were playing the point game and they closed a credit card that was 5 years old, and it really hurt their score, by a decent amount. So do not close any old credit cards when you're in the mortgage process. And the last piece is, a lot of times I'll see that folks have like $60 on a credit card bill or $60 on a phone bill or an internet bill they've forgotten. It's shown up on collections, and that can really hurt. So something that I recommend, go to annualcreditreport.com, get your free credit report from all the agencies, see if there are any sort of, $30, $50, $100 things that you've forgotten, anything you want to challenge or dispute, and that'll really help as you go into the process. So that's a little bit of credit 101. That's the second factor. The third piece is collateral. This specifically refers to how much is your home worth relative to the loan that you're borrowing. So it's the specific formula, or the acronym is LTV, or loan to value. So if you take a mortgage of $500,000 and you borrow, let's say you take a mortgage of $450,000 and your home value is $500,000, your loan to value would be 90. In common terms, it's sort of like the opposite of your down payment. If you're putting a down payment of 10%, your loan to value is effectively 90%. The reason they use loan to value is because loan to value is a measure of risk that the lender is taking. And essentially, the lower the loan to value or higher the down payment, the less risk the lender is taking. So that's how loan to value is used. It's determined by the appraisal process. You don't have to worry about appraisal right when you're buying, but when you get the mortgage and you're about to close, you'll get an official appraisal, and that's what determines your final loan to value. Yeah, I said LTV's, 1 minus your down payment. It's really interesting. The average down payment for the first-time home buyer is 6%. 20% is an absolute myth. It used to be when houses were $200,000 or $100,000, people had 20%. Now the average home price is encroaching on $500,000. Nobody has $100,000. So the average is 6%. You can go as low as 3% on a conventional loan, or 3.5% on an FHA loan. And this really interesting piece is that down payments have almost no impact on your interest rate. If you go from a down payment from 20% to 15%, your rate actually slightly increases because you pay PMI. And we'll cover next on how PMI is really one of the best deals that first-time homeowners can get. The way to think about it is, I find PMIs as low as 0.1%, right? So let's say your rate is 5%. You pay PMI, so effectively you're paying a rate of 5.1%. But instead, what you're getting is you're getting to participate in home price appreciation. You're getting to lock in your rate. Had you paid PMI last year and locked in your rate, you'd be sitting on a rate that's 3% right now. But just to think about that, it really helps you lock in home ownership and get a head start on building wealth. So don't be afraid of PMI. I always tell people PMI is your friend. Okay, well, let's go through PMI. Sorry if I said PMI, I didn't explain what it is. PMI stands for private mortgage. It's extra insurance to protect the lender against default. So typically, if you're taking a conventional loan means it's backed by Fannie or Freddie. They're two government-sponsored agencies. They require that borrowers pay PMI. It doesn't cost very much at all. It's sort of like the boogeyman. Everyone says, "Oh, I need to get to 20% down because I got to pay PMI." How much is PMI? It's $50. Well, would you pay $50 or would you continue paying rent for $2,000? So in some cases, PMI can be high, especially if your credit score is in the 600. So again, it sort of reiterates why you should work in credit. But if your credit score is decent, above 700, your PMI in most cases is going to be under $100 a month. It also doesn't last forever. PMI only lasts until your LTV gets to 80, or in this case, if you started with 10% down, how long does it take you to get to another 10%? The answer is usually 5 years. A little trick that I like to tell first-time home buyers is, if your home value has gone up in the last 2 or 3 years, you can pay for a $750 qualified reappraisal. Call your lender, say, I want to do a qualified reappraisal. And if the house reappraises, let's say you bought the home at 500, you put 450 down, you put 50 down, you have a 450 mortgage balance, but the home price went up to 550. Guess what? That extra 50 belongs to you. So now you have, close to 20% in your home, and you can delete it. So it usually takes 5 to 8 years if you don't do anything, but with home price appreciation, it's usually gone in 3. The benefits, like I said, you get to participate in wealth creation, you get a locked rate. And then there's this really sort of nuanced features. If your appraisal comes lower, let's say, you bought a home for 500, it only appraised for 480. Now there's a $20,000 appraisal gap. Instead of paying an additional $20,000 at closing, you can actually pay a little bit more PMI to cover it. And that way it's not a huge out-of-pocket expense. The very last C is the cash to close. The average closing costs are right about $7,000, but that's not all your closing costs. Your closing costs include your down payment. They include your loan costs. They include, underwriting fees, just all the typical mortgage fees. You start by budgeting about 3% of your home amount for closing costs. They range from 2 to 5. And the best part about this is you can redeem gravy rewards. So if you've earned up to 1% gravy rewards, you can directly offset closing costs. The last piece of advice I would give is make sure you negotiate for seller credits. Seller credits are amazing. So let's say you negotiated $10,000 of seller credits. It's 5 times better than taking a $10,000 price reduction. And the reason for that is if your loan amount, let's say, goes from $450 to $440, your monthly mortgage payment is not going to move at all because your loan is amortized for 30 years. Just because the $10,000 is spread out over 30 years, you'll see your monthly payment maybe move down by $20. But instead, you can use $10,000 of seller credits to directly offset your closing costs. So if you have closing costs of $20,000 and you get $10,000 of seller credits, your cash to close goes down significantly. So gravy rewards are sort of like seller credits, but seller credits are also seller credits. So you can use them to directly reduce the cost to buy your home. Okay, let's go next into types of mortgages. I break it down into, 4 high-level classes. The first one is FHA. It just, FHA is a government loan. That's the main thing to remember. There are other types of government loans like VA or USDA. If you've served in the armed forces, thank you for your service. You'll be eligible for a VA loan. USDA is for rural areas. If you live in a rural area, not suburban, actual rural, you can qualify for USDA. The first bucket is government loans. 80% or 90% of folks will fall in the conventional bucket. Conventional just means, it's not government and it's not too big. Let's come back to conventional. The next bucket is jumbo. All that means it's a loan that's big, and specifically it's bigger than $726,000. That number is also set by a government agency, and basically all loans that are smaller than that fall into the conventional bucket. The other, I'll just say it's things like if you are a non-W income earner, you need to use bank statements, or you're an investor, there may be some other loans, but first-time home buyers are mostly going to stick in the conventional bucket. Okay, so what is conventional? Conventional is a great deal because you only need to put 3% down. Second, these loans are backed by Fannie and Freddie that are 2 government agencies, so the rates are usually better compared to other types of loans. And third, they're relatively easy to get. You can get them, anywhere. All lenders offer them. And then there's some special classes of loans such as Home Ready and Home One. These are also for first-time home buyers. And in some cases, they're better than FHA loans. In a different discussion, I'll explain why they may be better than FHA in some situations. But most of the folks on this call will probably start with conventional. And for some reason, if it doesn't work, you want to look at FHA. Super. So then, of course, you have the types of different mortgages. Then you actually have the product selection. The 2 sort of high-level types of products are fixed rate mortgage and ARMs. ARMs stand for adjustable rate mortgages. In this case, it says 10/1 ARM. What does that mean? That means that your rate is going to be fixed for the first 10 years. And in the 11th year, your rate could increase or decrease based on, certain indices. So, I recommend, most folks to actually consider an ARM for 2 reasons. One is the average first-time homeowner actually only stays for 10 years or less. So in most situations, you will not even be there for the 11th year. The second is because it's a floating rate ARM and it has some risk. In order to compensate, for borrowers for taking that risk, the rate is structurally lower. So in this case, it's 0.75% lower, which means you'll save about $200 per month, or in this case, almost $3,000 a year. I have an ARM, I have a 10/1 ARM, and the way I think about it is that's enough money to pay for my annual homeowner's insurance. So it's really a saving for 10 years. In 10 years, you'll save almost 30 grand. And you really have to believe, to take a fixed rate mortgage, you have to believe, I'm going to stay here for more than 10 years. I don't think my income is going to go up, and I don't think I'm going to be able to refinance in year 11. If all those 3 things are true, you shouldn't take the risk and you should go with a 30-year fixed. But I would always recommend looking at the rate difference between a 10/1 ARM and a 30-year fixed as a first-time home buyer. Super. Here's the $1 million question. How do rates work? Everybody wants a lower rate, and I'm going to spill the secrets on how do you actually get the lowest rate available in the market to you. In order to get a low rate, you have to understand how it starts with a base rate. So this is the rate that a lender has available to them. The way to think about it is it has two components. One component is what the government sets as the 10-year treasury rate. We've heard a lot in the news, the Fed is increasing rates, the Fed is increasing rates. The 10-year treasury is linked to the rate what the Fed increases. And then there's a second component, the option to adjust the spread. I want to explain what that is. It's just a measure of fear and sort of uncertainty in the market. If there's more fear and uncertainty in the market, the rate tends to increase. If there's less fear, the base rate seems the same. The second piece of a rate is price adjustments. This is what is dependent on you. Do you have good credit? Your rate will go down. Are you putting more money down? Your rate will go down. Are you buying a primary home as a single family residence? You'll get the best rate. So these are all sort of borrower and loan and property characteristics that adjust the rate. But if you think about the rate being 5%, the price adjustments are on the margin. Maybe if you're getting a rate of 5.5, 90% of the rate is sort of determined by the base rate, and then 10% is sort of price adjustments. The last piece is the cost of the rate. So just because somebody is telling you that the rate is 5.5% does not mean that is the only rate that's available to you. You could ask them to give you a rate of 5%, but you would have to pay for it. Typically, to move a rate down from 5.5% to 5%, you would have to pay 2% of your loan amount. So if you're taking a home that's $300,000, you could pay $6,000 up front and reduce your rate from 5.5% to 5%. That's called a discount point. The second piece is the origination fee, right? Mortgage brokers make money and they charge those fees in there. So it's part of like, how much do they charge? Obviously, the lower they charge, like I charge half the industry average. So that's one reason my rates are so good. It's just because I charge less. So that's another piece to look at first. How much are you getting charged by the mortgage originator? These factors on the right are things that, we don't control, but these are just factors, good to know. These are things that affect the base rate. Super here, so you're taking a look and, obviously if you're a first-time home buyer, it's been really unnerving that the rates have doubled from 3% to 6% right now. But if you notice, the rates are starting to tick down from 7% to 6%. And that's because of two reasons. One, the Fed has already said that they're going to start slowing down the rates. So they've not actually decreased the rates, they've actually increased the rates at the last meeting, but the rate started to go down because the fear and the uncertainty factor started to come down. So, as mortgage professionals, we expect the fear and uncertainty factor will continue to come down. And then when stops and reverses course, mortgage rates will settle in the 5s and, maybe in the 4s in the next 18 months. So one thing to think about is, you're always quoted the rate, but right next to the number known as the APR. I would highly encourage everyone to look at the APR. The APR in a mortgage is not the same as the APR in a credit card. The mortgage APR is simply your mortgage rate plus all the costs, in your mortgage fees expressed as a percentage. So let's say, mortgage rate is 5.5%, there's $20,000 of mortgage fees, not your down payment, just of like fees, all the fees that you're paying. So your APR will show as 5.87. So what you want to do is you want to go from lender to lender and compare the APR to make sure you're also getting not just a low rate and a great deal, but also a low APR, because fees can be hidden in and out of the rate, but they cannot be hidden out of the APR. They will be present. Okay, so what's new for 2023? The first thing I would say is, going through the mortgage process, always advocate for yourself. You are making, what is most likely the largest financial decision of your life, at least up until now. Maybe you'll get a bigger and better home in the future and it'll be, even bigger. But given that you're making, such a large financial decision, it is your responsibility to understand how does the process work. Get mortgage ready, talk to a knowledgeable broker, get pre-approved, talk to an agent, interview agents, make sure that they're giving you a great deal. Agents will say, hey, we're not charging you anything, but, they're getting paid. So interview them to make sure that you like them. Start the house hunt, and then in the mortgage process, I find that it's overwhelming to be buying a home, which is an emotional decision, and then that's mixed up with a large financial decision. So try to keep the two separate, get a trusted advisor, a mortgage coach, read yourself and make sure that you feel confident about your financial decision almost before you enter the house hunting process. Like Will said, it's all about getting ready and doing all the hard work before you even go home shopping. The second piece I would say is get 3 quotes from 3 different sources. Gravy is a great place to get quotes. Will and the team there has already pre-negotiated rates with great lenders across the country, and they'll give you 5-star service. Talk to a mortgage broker. I'm a mortgage broker. There are others out there. And the great thing about talking with a custom, with a broker is you might get a customized rate. You'll understand if you have a special situation, it's not clean cut. We're really problem solvers who will help you solve the specific problem that you're saving. In my case, I also help redeem Gravy rewards. So you'll get all the benefits with me. And the third one I'll say is definitely go to a local credit union or bank, because credit unions are great about offering discounted rates, especially for their members. Sometimes they'll ask you to be a member, but I would definitely get a third quote from a local bank or a credit union. Something that I wouldn't advise is just, go shopping only online, because online the rates are terrible, because folks know that, hey, everybody's on the internet, but oftentimes, right, you'll get a worse rate if you only shop online. So make sure to get 3 different quotes from 3 different sources. Super. And then the last thing I'll say is, in 2023, the new conventional loan limit is $726,000, which is amazing. What that means is if you qualify based on income, it'll be relatively easy to get a loan up to this amount. And this amount was increased by 12% in the last year. That's the largest ever increase that I've seen. The second piece is that LLPAs, which refer to those price adjustments. Remember how I said there was the base rate and then the price adjustments? These are government mandated price adjustments that usually end up costing first-time homeowners $3,000 to $4,000. If your income falls below 80% of the area median income, there's a map. I can send you guys a link. If your income falls on that level, those costs no longer apply to you, which is great. So you'll get another $3,000 or $4,000 of savings only if you fall at 80% below your area's median income level. And the last piece is, now Fannie and Freddie have asked that lenders include 12 months of rental history while borrowers are being qualified. So that's great. If you're paying your rent on time, you can ask your lender to include that in their underwriting procedure.
Awesome. Thanks, Sukesh. And maybe just to piggyback on that last one, the rental payment history, ask your lender about it. They can look at your bank statements and see those payments and pull them into underwriting for you. You don't need to pay someone to report your rental payments to the credit bureaus. That actually doesn't help you improve the credit score that lenders look at when you're going to buy a house. So ask your loan officer when you apply for a mortgage to take a look at your rental payment history, and they will. So I see a few questions here in the chat. Let me see here. Sukesh, maybe you can take this one. Can you refinance an ARM loan after the first 10 years if your rate goes up?
Correct. You can refinance. So in fact, all mortgages can be prepaid at any time without penalty. After 2014, there was a rule that was made that you can refinance any mortgage at any time. There are some exceptions, but for all intents and purposes, you can refinance any mortgage at any time. But if your rate is going up in 10 years, absolutely you can refinance it. You might want to refinance it to a 15-year loan, not a 30-year loan, because if you're refinancing and the rate's going up, the existing 30-year mortgage is probably also in a higher rate. So you can refinance. It's just a question of do you want to or not. And a lot of times what I see is folks, because their ARM is lower for the first 10 years, they'll make a few extra payments. Their mortgage balances come down a decent amount. And then when they refinance to a 15-year. And then now they're sitting on a 25-year mortgage instead of a 30-year mortgage. So that's the typical strategy while refinancing.
Great. I see one here, redeem Gravy rewards for up to 1%. What happens with the rewards money that you've saved if it's over 1% of closing costs? So the cap is 1%. If you get a $500,000 loan, you can only redeem up to $5,000 with our lender partners as a credit on those closing costs. Unfortunately, if you have more than $5,000 in that example, you cannot redeem those when you get a mortgage. We do have some exciting plans that are a little too early to announce for what we hope to let you do with those excess rewards when the time comes, but we'll put a pin in that one for another day. The key point here is you can only redeem up to that 1% threshold as a credit on closing costs with your Gravy rewards on the lender side. And then there's also rewards you can redeem on the agent side in addition. But again, up to 1% of the loan amount as a credit on closing costs is the max for Gravy rewards with our lender partners.
But I will say one thing, well, that, if you have more than 1%, you're almost waiting too long, because, even a $400,000 home, if you have $4,000 of Gravy rewards, which means, you've paid something like $200,000 of rent, so you've been renting for a while. So buy earlier.
How do I find a real estate agent that specializes in first-time home buyers? How early in the process should I choose an agent? So we partner with amazing agents that are coast to coast and local experts wherever you are, that specialize in first-time home buyers. That's some of the biggest kind of real estate brokerages that we all have heard of, know, and love. Where in the process is a really good question. Sukesh, I'll hand it to you in a sec for your opinion. We generally advise folks have the initial consulting call with a lender first, so you get your arms around what can you understand, how close are you to being pre-approvable, and that's when you should open your Gravy app and talk to an agent, and we'll connect you with one of our amazing partners. So they tend to be 3 to 6 months before you want to buy a house, and the agent and lender conversations start somewhat simultaneously. We tend to guide folks towards talk to a lender first, and then if that conversation goes well, then start talking to an agent. Sukesh, does that kind of align with how you tend to advise folks, or do you have a different take?
Yeah, I think, a lot of times, if you're connected with a lender, they'll have folks in their referral network. I would also ask family and friends. But the main thing, I always advise is interview your realtor, right? Because they're providing a service and they're going to, make a decent living. So they should, gel with you, that you should be on the same sort of wavelength, and, they should understand your needs. I would, set up a short, like 15-minute interview and interview 3 folks and pick one. Don't just go with the first person that you find. But yeah, I think Gravy will connect you, a lender will connect you, or you can also go, read Zillow reviews is a great place to find great realtors as well.
Great. There's a few in here, which is awesome. Maybe we can do a little speed round. Sukesh, who do you ask for seller credits?
That is something that you will talk with your realtor and negotiate that while you're negotiating your offer. So in the offer process, basically, you will tell your realtor, hey, I want seller credits. Your realtor will talk to the seller's realtor and they'll sort of write it into the contract. So, but yeah, that's a place where you should advocate yourself, because even realtors don't always understand like the math behind how seller credits really help your closing costs. But if you tell them, they know exactly what it is and they'll do it. It may not always know like the math behind them and why they're so important. So if you just tell your realtor and tell them how much you're looking for, and they'll negotiate it.
Gravy rewards don't work with credit unions, ? That is true. We actually make no money when you get a mortgage with our partners or without. We're just here to try and get you the best deal. We think that comes from working within our network with folks like Sukesh or some of our other national partner lenders. But we want you to shop around so that you get the best rate and the best deal. We think it makes sense to have a chat with your local credit union to see what they can offer for you. In some cases, that may be the best deal, even without Gravy rewards. We think in many or most all cases, you'll get the best deal when you redeem your Gravy rewards with Sukesh or with others in our network. But we are somewhat of a Switzerland at Gravy. We we want you to get the best deal on your first home, whether that's within our network or without. We work really hard to make our network lenders cut you an amazing deal. But if you can do better elsewhere, it probably is at a local credit union, if at all. And so you should have a chat with those folks and see what they can do. Why do we want rental payment history involved in underwriting? Does that just help you get a better rate? The short answer is yes, it can only help you. It cannot hurt you per the new guidelines from Fannie Mae and Freddie Mac. And so if you are someone that would receive a boost to your credit and borrower profile because the lender sees that you've paid your rent on time 12 months in a row, then they will factor it in. It will lower your rate, which means you can either afford a bigger mortgage or you can have a smaller monthly payment, and that mortgage becomes more affordable. It can only help, it cannot hurt. And so it's always a great thing to ask for to help get that rate down. Do you also need to get a title in addition to a deed for the home you will buy? Sukesh?
Correct. Yeah. So the title is interesting. So you have a title agent, and what the title agent does is three things. One is they verify identity, but two is they settle the cash, like all the money goes to them and they sort of distribute the balances. But the most important thing is they issue a title commitment, and all that title commitment is doing is it is an insurance against somebody else claiming an ownership right to your property. If somebody else does claim it, the title commitment, it's their responsibility to fight that in court. So title just is it's like a insurance against somebody else making a claim to your property. But it's not part of the mortgage. It's just, it's like you have homeowners insurance, you have title insurance.
What is the maximum amount you can buy down an interest rate?
So the maximum amount you can buy down depends from lender to lender, but there is a fee tolerance on how many points you can buy. It's usually like 3%. So, if your home is $300,000, it'll say you can spend a maximum of roughly $9,000 to buy the rate down, which will reduce your rate, on the very high level, probably by 1% to 1.5%. So if the current rates are 5.5%, the max you could probably buy it down to was like 4.2 or something. So it's not unlimited. It's usually like 3%, 2 to 3% of your loan amount.
Are there any plans to increase the APY on the Gravy savings account? Short answer, yes. You'll see a notification from us in your inbox in the next couple of weeks. It is going up considerably, and I think will be extremely competitive, if not better than almost anything else you can find in the market. So keep an eye on your inbox, probably first week of the new year, if not a little bit sooner. But the short answer is yes, the APY on the Gravy savings account is about to go up. Are there programs for first-time home buyers with low credit scores?
Yeah, so I would say two things. The answer is yes, but also you can do a ton to quickly boost your credit score. In terms of, if your credit score is under like in the 600s, you can go as low as 580 on an FHA. And oftentimes if your credit score is in like 650, even though you qualify for a conventional, I recommend the FHA just because the rates are better. The downside to an FHA is, it just takes a little bit longer to qualify, and there's this fee. It's like a 1.75% fee that you got to pay the government. So that makes it more expensive to close on the home. But FHAs are great for, if you have medium to low credit. The second piece I would say is it's very easy to quickly bump your credit. Sort of paying off any sort of like small collection items bumps your credit. If you have a $3,000 credit card, just bringing it to under $2,000 really bumps your credit score. Making all your payments on time, that's probably the number one most important thing. And the last piece, sort of the trick that I mentioned, is if you have credit cards and let's say you carry, you don't even carry a balance, but you pay it off on the 20th every month, but the statement closes on the 1st, I would pay it off on the 1st before the statement closes. So your credit card statement balance says 0. And all you're doing is trying to minimize your credit utilization. I don't know if that tip was clear, but just pay off as much of your credit card as possible for as long as possible right before you apply, and that'll really help your credit score, which helps your mortgage rate.
Perfect. And maybe to piggyback a little bit with some specificity on, what is low in terms of credit scores. So yes, there are absolutely FHA programs, to Sukesh's point, that focus on first-time home buyers. Generally, it's 580 and above. You have more options once you're at 640 and above, but there are some rare scenarios where if you are above 500 and below 580, you may be able to get a loan. Sukesh has the right idea here. The more you can do to get that score up, the more options you have and the better pricing you will receive. But there are a lot of great options out there for folks that have done all of the work to improve their credit score and still find themselves at 580 or 600. And those are all great conversations to have with a loan officer. They have a ton of awesome tools to help you navigate those waters. Can you recap how to redeem Gravy rewards? Yes. So there's two flavors of Gravy rewards. The first is what you see accruing in the app. That's what you get for paying your rent. And that is called closing cash, and it's redeemed as a credit on the closing costs of your loan when you work with our partner lenders. So in order to redeem those rewards, you will, in the app, navigate to the main menu, or there's a few other paths to get there, and tap find a lender or get pre-approved. You'll answer some questions in that flow, and eventually we will connect you with one of our partners or multiple of our partners if you're so inclined. Those folks work really closely with us, so they will know how much Gravy rewards you have in terms of your balance, and they will automatically apply those Gravy rewards as a credit on the closing costs of your loan when it closes. So the beauty is you can go right from the app, find one of our awesome lender partners or multiple, have a conversation with them. They will know exactly what your Gravy rewards balance is, and they will automatically redeem it as a credit on your closing costs when you close. The second flavor is called a home buyer bonus, and it's redeemed by our agent partners. So similar story, you can go into the app and click find an agent. And when you do, we will ask you a few questions and then match you with an agent in your local search area that is in our list of excellent real estate agents that love working with first-time home buyers. That home buyer bonus is all or nothing. So if you buy a home with one of our partner agents, let's say it's a $325,000 home, you'll get a $1,000 or $1,200 home buyer bonus that is sort of paid either at or shortly thereafter from the transaction. Again, our partner agents, we work really closely with them. They will do all of this automatically for you. And really the best way to save the most money is to stack both of those. Work with one of our lender partners, work with one of our agent partners, cash in your closing cash and your home buyer bonus, and you can save many thousands of dollars on your first home purchase. You don't have to work with both. You can do one or the other or neither. Like I said earlier, we're Switzerland in many ways. We are here to help you buy your first home better, faster, smarter. And in many cases, you may already have a loan officer that you really like or an agent that you want to work with. That's totally fine. If you don't, we've got you covered because we've got a whole bunch of awesome people that would love to help you. Next one, how does Gravy make money? Great question. The vast majority of our revenue comes from what we call Gravy Plus. It's the premium version of the Gravy app that you may have seen when you open the application. That costs $60 a year or $6.99 a month and unlocks 4 key features. So instead of 5% back on rent each month, you get 10% back, which you can redeem as a credit on your closing costs. It unlocks our mortgage credit suite. So it helps you track, understand, and build the credit score that mortgage lenders actually use when they're qualifying you for a mortgage, which is just a different score than what you see from Credit Karma and NerdWallet and some of those other services out there. It unlocks gifting from family and friends. So we make it really easy for friends and family to put a credit card into your public Gravy profile that you publish and contribute towards your house fund. So think wedding registry, baby shower, holidays, just because we really want to help folks in some ways crowdsource their down payment if that's of interest. 1 in 3 first-time home buyers already gets help from friends and family. Yes, we want to make it easier for them, but more importantly, we want to help the 2/3 of folks that aren't able to tap into their networks just yet to kind of source some of that down payment funding from the people who know and love them and candidly want to help. So we make that really easy. The last one is live home buyer coaching calls. So you can schedule a Zoom call with our team anytime to check in, make sure you're on track, create a plan, ask questions. And so those 4 features are what unlocks Gravy Plus. That's where we get the majority of our revenue. We do also make a small commission when you work with one of our real estate agent partners. Comes out of their pocket and not yours. But to be fully cards on the table, we do generate some revenue. Our goals are all aligned around you being able to purchase the home, and we actually make less than your home buyer bonus is. But we do receive some compensation from those real estate agents for introducing Gravy members to them. So those are really the primary ways that we generate revenue. Gravy Plus while you're in saving mode, and then there's some revenue that occurs at the transaction point from some of our partners. Next one, this is great. This is a great platform. I am hoping to buy within the next 3 to 4 months. Do you guys need any success stories? How can we best engage with Gravy? Thank you. I don't know if that was planted by one of the Gravy team members, but whoever put it up there, I appreciate it. That's awesome. That's also super exciting that you're getting ready to buy in March, April of next year. That's coming up quick. That's so great. And the short answer is yes, we would love success stories. How can you engage with us? You've got my email address, and my contact info and cell phone is on the next slide. Text me, email me, call me. I would love to chat with you. I am all ears for things you like about Gravy, things you don't like about Gravy, things you're struggling with that you'd like us to help out along your journey towards homeownership with. We are all ears, so please don't hesitate to reach out at any time. And we'd love to be a part of your home purchase come March of 2023 or April of 2023, which will be here before we know it.
I'll take this next one, Will.
Awesome.
So as long as you have a little bit of a down payment, you can get a mortgage. You cannot be denied for a mortgage if you have the income and the down payment, and you have a credit score that, in fact, 620, you will even qualify for a conventional. The thing where you might get hit is just how much you qualify for and what the rate will be. But you can qualify for a mortgage. You're typically, what you may be denied for, if you try to apply for, a really large loan that you can't carry, you might be denied for that size. But if it's a reasonable size loan based on your qualifications, you will qualify.
Awesome. May I see a list of lenders before applying? Yes, absolutely. If you go into the app and click find a lender and navigate through that flow, you'll see a list of all of them right in there before you hit submit. And before we make any connection, you can see that entire list. It's also posted on support.gravy.co. There's a list up there as well. So please take a look at that. Reach out if you have questions, or if there's someone that's not on that list that you think is amazing that we should be talking to. We're adding more lenders all the time, and so we would be happy to do that. I'd also just give an extra plug here for Sukesh. His contact information is going to be on the next slide as well. He is a savant when it comes to all things mortgages and helping first-time home buyers get the keys to their first house. So he should be at the top of your list as well. And I know he'd love to help you all out. So please don't hesitate to reach out to him either via email or text.
Thanks, Will.
Thank you. We'd love it if you shared this on social media. Again, feedback is super valuable. We're trying to make this the most powerful tool for first-time home buyers out there. Really everything from the first step you take towards home ownership through to getting those keys. And it's going to take feedback from folks like you for us to get there. But we're also looking to help as many of the 100 million renters in the country that aspire to own their own home as we possibly can. So if your roommate is thinking about buying a home at some point in the next few years, your brother, your sister, your friends, whomever, please let them know about Gravy. And we'd love to help them too.
Yeah, USDA and then VA loans also go down to 0%. And the last thing I'd say is you can just search for down payment assistance programs. They're called DAPs. Just look in your area, look DAPs in my zip code, and it'll show up what they are. They come in two varietals. The first one is a legit grant where, the local agencies are giving you literal money to help with your down payment. And the second one is in the form of a loan, and that also helps to get a home.
Awesome. I think that about does it. Thanks for folks putting some kind words into the Q&A box. We really appreciate your time. We'd like to do more of these as we go forward. So if you have feedback, questions, other things that we should cover next time, please let us know. We want to make these sessions really useful and valuable for you all. So don't hesitate to reach out. Our contact info, as I mentioned, is at the bottom here. If you don't have the Gravy app yet, you can download that from the Apple App Store or the Google Play Store. And more so than anything, thank you all for taking the time to be here. We really appreciate it. I hope everybody has a happy holiday and an amazing new year. Thank you to Sukesh for teaching me quite a bit today. That was awesome. So thanks, Sukesh.
My pleasure. Well, happy holidays, everyone.
Thanks, everybody.